At the crossroads of growth and maturity, Converge ICT Solutions now commands the spotlight. A company both admired for its rapid ascent and scrutinized for its next moves. For investors in the Philippine telecom sector, first quarter 2026 results demand attention, not simply for the numbers, but for the narrative those numbers reveal. Revenue reached 11.19 billion pesos, marking a 4% increase from last year. Yet, net income remained essentially unchanged at 3.02 billion, and earnings per share held steady at 42 centavos. These figures tell a story familiar to seasoned telecom investors. Modest growth, steady profitability, but a rising need for capital. Converge is investing aggressively, expanding its network, building data centers, while still rewarding shareholders with increasingly generous dividends. But here lies a challenge. In the first quarter, free cash flow totaled roughly 2.46 billion pesos, while dividends reached 3.55 billion. The shortfall was covered by new borrowings, debt that rose to nearly 30 billion by March's end. It's a pattern reminiscent of the old PLDT playbook, where steady dividends and capital investments were backed by rising leverage. Yet, Converge's balance sheet remains less stretched. Its gross debt to EBITDA stands at just 1.2 times, with solid coverage ratios and ample liquidity. The critical question is whether this borrowing is fueling future growth, or merely supporting returns as core markets slow. On this count, the residential broadband business, Converge's historic growth engine, is showing signs of fatigue. Only 1% revenue growth year-on-year, despite gains in the prepaid segment. As household expansion cools, the weight of competition and the importance of subscriber quality grow. Enterprise, by contrast, is emerging as the new source of momentum. Revenue rose 16% to almost 2 billion pesos, and investment is focused squarely on serving enterprise clients and building out digital infrastructure. The opening of the Angeles data center signals an intent to capture data residency and high-performance computing demand. If these bets pay off, the story remains one of productive reinvestment, and leverage, for now, is a tool to accelerate expansion rather than a cause for worry. Yet, some caution flags persist. Operating expenses are rising faster than revenues. Receivables, especially from residential segments, continue to climb, and provisions for impairments remain stubbornly high. Dividends now outstrip free cash flow, making discipline in collections and cash conversion critical to the sustainability of shareholder returns. Still, Converge's capital structure is healthy. Cash and short-term placements approach 14 billion pesos, net debt remains moderate, and untapped credit lines offer flexibility. Return on invested capital, while down to 15.6% from 17.3%, is resilient, though directionally, it warrants scrutiny. The bottom line? Converge stands at a pivotal moment. The company has not yet crossed into the realm of balance sheet distress, but the trajectory of capital allocation, earnings power, and market evolution is becoming increasingly clear. For investors, the task is to watch these trends, weigh the risks and rewards, and assess whether today's borrowings are fueling a new phase of growth or simply sustaining mature market returns. The groundwork for the company's future performance is being laid now, requiring clarity, caution, and an active eye on the essentials that will define its next chapter.